And so there's lots of things that you can look back on and say, if I had only done it this way, but that information was unknowable at the time. You can have a good decision-making process, but still a bad outcome. And you can also have the inverse. And whatever outcome you get, don't let it influence your decision-making process.
From $50 million in circulation annually in venture capital to about $500 million, this 10x growth in a short amount of time in Oklahoma caught my attention. So when Nathaniel Harding of Cortado Ventures invited me out to Oklahoma City, yes, the middle of America, for the MidContinent VC Summit earlier this year, my answer was yes. Today's conversation is with a leader unlike any other I've had on the show, a former Air Force captain stationed at the US-NATO headquarters in Afghanistan. Nathaniel transitioned from military service to become a successful oil entrepreneur, leading a venture that ultimately exited for a staggering $120 million. But what truly sets Nathaniel apart is his unwavering commitment to positive change. In 2018, his company played a pivotal role in discovering one of the largest new natural gas resources in the United States, and today he serves as managing partner at Cortado Ventures, which has just announced its oversubscribed close-up fund 2, investing in early-stage startups in the mid-continent region of America. You don't want to miss this. Nathaniel, I'm so excited to be here in Oklahoma City, your hometown.
Welcome.
I'm so
Wonderful
excited. We had such a great time yesterday at the MidContinent VC conference, the first of its kind.
The first of many. I think it went great. So thanks to people like you for making it special.
I mean, let's get started here with, why did you decide to do this? Why now? Has this ever been done before in this forum in Oklahoma City?
The MidContinent Venture Capital Summit, it was something that really was an outcropping of ideas that we've been working on for a while, but also taking inspiration from other markets where venture capital there's more of it. And whereas in our part of the country, it's a newer asset class, certainly growing. We think it's grown about tenfold really in the past few years.
Really?
And the idea was to shine a spotlight and to give the market a name. And interestingly, the name Mid-Continent is actually borrowing from oil and gas. So like in this part of the country, we know exactly what Mid-Continent means. Outside of this part of the country, they don't. And so it's our way of saying there's now a new way to think about what is happening in the Mid-Continent, that venture capital has arrived. It's a flag for entrepreneurs and innovators and investors to come and be part of that.
So what is the Mid-Continent? As you said,
sure.
Those in oil and gas know all about it. But for me, I even had to ask Mike, which are the states? What do we consider? Is there a reason why you've chosen these 6 states to be representative of the market that you're in?
Yeah, it's Oklahoma and the states that touch it. So that includes Texas, Arkansas, Kansas, New Mexico. So these are all areas and even Missouri. So these are all areas that we see a lot of activity across certain sectors like energy and logistics, because there's a lot of economic corridors that share similarities. So you think of, for instance, in energy, Oklahoma and North Texas. You think of aerospace, Tinker Air Force Base, one of the largest bases in the world, up to Colorado Springs, logistics, Tulsa to Bentonville. So a lot of these sectors where we have similarities between, across the mid-continent, we're really putting it all together and saying this is an area that is overlooked by Coastal VC. It's an area that we know well because we've spent our careers here and built companies here. And an area that there's now more innovation happening than ever. A lot of it has to do with digitizing of real assets, AI meeting legacy industries. Things that really weren't possible or weren't happening before are now happening. And so that's why you see this third wave of venture capital coming into what we know affectionately and have built our careers in the mid-continent.
Yeah, so very exciting. I mean, as I was preparing for it, I myself was not aware that 75% of all venture capital actually goes to 3 main states, and 20, that is California, Massachusetts, and New York.
That's right, yeah.
So the 3 states getting 75% of venture capital, which means the rest of the country is competing for that 25%. Now you're talking a little bit about the shift of innovation driving the change that you're seeing with the level of entrepreneurship. Is the capital following? Are we going to see a change in the percentage split of venture capital here?
I've seen some data actually recently that was talking about the overall venture capital dollars have shrunk compared to last year. Last year was a record year. Year before that was a record year. But that shrinkage has actually been in those areas you just described. It's actually been growth still in places like the MidContinent and Midwest, places outside of the coast. And so it's actually, I think, even more telling that when overall the dollars are shrinking, and in the places where it's been dominant has been shrinking, it's actually been growing here.
Okay, so a lot to dig into there. But first thing, because we're fresh off the big conference that you put together yesterday, what was your key takeaway before we go deep into your own story and what brought you here?
I think people, including myself, were blown away. That was actually a phrase that we heard, or different versions of it. Yeah, 250 people in a room that had capacity for 200, but the demand was just so high. And we had an amazing mix of, roughly a third of the audience were check writers, investors of different kinds. A third of the audience were innovators at different stages, all early stage and high tech. The other third being ecosystem builders, sponsors, our team. And the quality of speakers, the fact that we had people from 15 states, 33 cities, 4 countries, that were all, in fact, I think 10 or 12 people in the room had never been to Oklahoma before.
Including myself.
That's right. And so I love seeing that, because you have people that have been here forever and building, but also people that maybe are in the region that are investing here, and others that maybe are outside of the region that are seeing what's happening or want to learn more. Yeah. And that's exactly the point of it. So just the caliber of speakers, and just the production quality, showing that this is a real deal and people should pay attention to it.
So this is serious. This is the real deal. Yeah. And Nathaniel Harding is the real deal. Let's learn more about him. So let's go way back. In true billion-dollar moves fashion, you studied Russian and mechanical engineering. A very interesting mix. What was in your mind as a young boy here?
Yeah, that's a great question. So I always wanted to learn another language. And at the time, I had kind of 2 different ideas. At the time, there's a lot of oil and gas development happening in Russia. So I thought, well, that might be really, a strategic move to learn that. Where I went to high school, I went to a prep school in New Hampshire. They happened to have an amazing Russian program, so I was able to test out of 2 years of Russian when I went to college. And oil and gas was really booming in Russia. I also had an interest in future opportunities at the State Department, and Russian is a strategic language. So I was kind of hedging my bets, but also doing kind of a bucket list thing of learning another language. I've now forgotten a lot of what I've learned. My teachers would be appalled. But that kind of peak in college, I got a chance to go to Russia several times, and even volunteered at an orphanage. And I was the only volunteer that spoke Russian, so I ended up being a translator as well. So those experiences were amazing and very thankful. The mechanical engineering was, I wanted to work in technical fields, including in energy. And mechanical engineering is very diverse. You have a lot of opportunities out of that. So that was kind of a strategic selection as well. The number one thing I got out of engineering is problem solving. People ask me, do I still do free body diagrams and do fluid dynamics? No, I could maybe name some of the equations, but that's about it. But the problem solving that I built because of engineering is I still use today.
So, but I'm curious, mechanical engineering, that makes sense, right? That was in your blood, you're in a family, you're the oilman in many ways, the next generation, and we'll talk a little bit about that. But this intent to be an international citizen, to serve, and you later on went to serve as a captain, where did all this sense of patriotism, I suppose, come from?
Yeah, you're right. I've had a lot of experience that's taken me abroad, both in the kind of professional capacity, but outside of that as well. I've always admired people who serve their country, and the level of training that you get to become an officer, and that leadership, but the ability to work and serve my country was always something that I really valued and envisioned myself as a young person. That's what I want to do. I want to be somebody who steps up, signs up, served my country in a war zone. I actually went to Afghanistan in 2012. Very proud that I did that. The amount of training that you get to go in the military at all, to be an officer was huge. I'm very thankful.
So we talked about this earlier. You're one of 6 boys in your family, come from a mixed family in Oklahoma City. Actually Norman, right?
That's right.
Where the horses, so I'm thinking ranch, cowboy hat, you in those boots and all that.
Yeah, our neighbors were farmers. We were surrounded by farmland, yeah.
So do you think, that path of wanting to serve your country was also part of, I guess, your experience in childhood and wanting to stand out among your brothers?
Yeah, with 5 older brothers, with 6 of us, it was, you definitely have to do things to stand out. You have to eat quickly. And my brothers were, kind of a mixed family. So my brothers are much older than me. And so kind of seeing what they're doing and oftentimes looking back, I realized that some of the choices I made were trying to just be different. Well, he played basketball, he played baseball. I needed to do something else. So I was the weirdo from Oklahoma that played ice hockey. And I loved it, those kinds of choices. But also I think, looking back on it now, growing up in frankly what's kind of a rural area or a rural part of a suburb in the middle of the country, there's a lot more people that I think have that kind of very American identity, more traditional and more service-oriented, certainly, like service in the military. So I think some of those things fed into it. And I had, one of my brothers did go into the Navy. He was a doctor in the Navy. And so, of course, I had to do some other branch. I did the Air Force. So I think there is some of that. There's some sibling rivalry as well.
Yeah, for sure.
Who's more patriotic or who went outside the wire more. And so that's always a part of growing up in a big family.
When it comes to running a banger business, nothing matters more than generating revenue. But sales folks aren't just closing deals, they're tracking down leads, forecasting growth, whipping up reports, managing contacts, creating content, crunching numbers, the list goes on and on. With Q4 around the corner, there's a better way to win. And it all starts with the new HubSpot Sales Hub. With HubSpot Sales Hub, your data, tools, and teams are fully linked inside a smart and highly customizable platform that feels good to use. Turn prospects into pipeline and close the deal all in one place. Plus, sequences and smooth workflows helps reps streamline tasks and spend more time on what they do best, connecting with customers. With Sales Hub, closing deals is no big deal. Try it for yourself at hubspot.com/sales.
Yeah, so we're going to touch on this just very quickly because, of course, you and I are part of a community where we have some really high flyers in government and politics, and geopolitics is top of mind. And, of course, you served in Afghanistan, and we've, taken a very different turn. How do you feel about that?
I was actually in Kabul at the airport where all that was going down. So all the news footage and the things when they're talking about the Kabul airport, that's where I worked. And I was actually working when I was there in 2012 on the transition, which was a very long-term plan. Yeah. Well, 10 years later, our exit, that was not the original plan. But really, the insight that I'll take away from it is that I observed in my time there, and I learned from others, because I actually got to work with Afghan military and civilian authorities, that our preconceived notion that everybody has a national identity, and it's a strong one, I think that perception, that national identity and cohesion is not the same way in Afghanistan. In Afghanistan, people identify more with their local communities, more with their province. When you consider that context, it's perhaps a little bit less surprising that once the U.S. left, you had people taking their uniforms off and re-identifying with their local community. It sounds unusual to us because in the U.S., we're very much American first and then the state you're from, second. And I think it's just different in other cultures and specifically in Afghanistan.
Yeah. And were you disappointed with the way that all turned out?
Disappointed maybe has much to do with because we worked so hard, we did so much. I gave a lot of my time in that effort, and to see it go to waste is just a shame, I guess. And ultimately, I think it was the wrong approach, and perhaps having some kind of presence is not unexpected. I mean, if you look at our presence throughout the world, there's reasons that we have bases, throughout the world. So it's not unusual to even think that we would have an enduring presence there. So those are things that where the disagreements abound and disappointment in how it was managed.
Yeah. So we talked a little bit about this, the fact that you come with a very strong sense of American identity. And I think this is very clear with a lot of Americans today. Part of that, I think, and I'd love to hear if you agree, is the blood of entrepreneurship, of business first, of innovation. And now you've taken it in a different form. But do you feel that is part of the secret sauce? Why aren't other countries as nationalistic as we are in some way?
Yeah, there definitely is an identity, a national identity in the U.S. that embraces and loves entrepreneurship, right? I mean, that's a huge part of who we are. And I'll even take it a step further. In Oklahoma, some people know that in 1889 there was a land run. So overnight we went from a population of, essentially 0 to 10,000, and people staking their home in Oklahoma City and the region. So these people were risk takers. They were going out and doing a new thing, and so that's still in our blood, in Oklahoma. But even just, I think the national identity across America still very much identifies and celebrates the entrepreneur. And so I think that's reflected in the number of small businesses in the U.S., per capita, or however you want to look at it. The fact that venture capital is certainly, at least in its current form, was born in the U.S. and it's still the strongest here. I think those are all outcroppings of that identity.
Yeah. And you began building this identity as an entrepreneur after your stint by going into family business. Tell us a little bit more about that chapter of your life.
Yeah, and I do have an entrepreneurial family for sure. So my grandfather, my great uncle, my dad, brother, we've all been our own bosses at various times, and we've all worked for our dads as well. I guess, learning or almost being an apprentice and then going off on our own. So the family business, oil and gas exploration and production company. And so we would lease land, we would drill wells, operate the wells for any number of years, and bring in infrastructure to sell product. But then we identified an opportunity to really develop a new area, using at the time new technologies around horizontal drilling. And we developed our acreage, again, growing more in those 3 years than we had the previous 30 years combined. And then we sold in 2013, and it was a great outcome for us and our investors, and really cut my teeth on the entrepreneurial approach and using technology to develop a business.
It sounds like you came in young, guns blazing, and then took your family business to an exit, which was a great outcome. But of course, with family business, and I have many next generations on the show as well that have gone on to build their own paths, there's almost a tug and war between legacy beliefs and the new generation. Was there any of that during your time?
Yes. There were no secrets about it, but certainly difference of ideas on what should happen next. I was very thankful to be able to have kind of us younger people in the company be listened to and be taken seriously, and then eventually be able to take over different elements of the business. And because of that, transform the company from really a company that was operated in the same way that companies had been since the 80s in that industry, to really a technology first, digitizing our assets, and then using new technologies to develop our...
And what does that mean, using new technologies?
For instance, like bringing in telemetry to be able to control and view data in real time, operations across the asset. Eventually using 3D seismic to gain insight into what was underground, right? Really bringing in new technologies to try to quantify, identify where we should drill, but then be able to have real-time information on our operations across the asset. And those are things that we brought in as part of that development.
And why do you think that was necessary at that time? I guess what I'm getting to is, how did you find your stamp within a larger organization, and that this was the path that you wanted to take the company to?
Some of it was that I had worked for a large corporation in Canada that was doing these things, and so I kind of saw what that looks like. But then seeing that there's so many efficiencies we can gain if you brought those into a small company, really evaluating what's kind of worth, not just technology for technology's sake, but what is actually going to enhance our productivity. And so those are some of the things that inspired and trying to push the company into that next level, but also seeing that we had a real opportunity to develop an asset to a level that was going to be substantial. It was going to require a lot of capital. We ended up deploying over $100 million, gross over that time.
And what was unexpected in your time there? I mean, in running a family business, did you come in or you parachuted straight away to CEO? How did that whole journey work?
No, it started off as just a staff level engineer, and then started managing other engineers, and then grew into a vice president of operations type role. And so by the time we sold, me and my partner, Kevin Dunnington, were really the kind of insiders leading the company on a day-to-day basis. And then our founders, my dad and John Shelton, were certainly board level type roles by the time we exited. And then after the exit, after we sold the company, then we started our own company, and that's where we really became a again, bootstrapping. So it's almost like starting over. You sell the family business, and then you bootstrap your next business. And then we brought in private equity to further develop our own company after that.
So essentially, you collected all this data to also package the story about why this business is a good buy, right? Essentially, to get to that exit. And you got to that level of exit. Who bought the family company?
It was at the time a company called Lighthouse Energy, and those assets have now traded hands a few times. So Lighthouse acquired the property in 2013 with private equity backing, including from Energy and Minerals Group out of Houston. And so that was, you're right, we had a whole process that took the better part of a year and didn't get what we wanted out of that. And so then it became a protracted negotiated sale. So I guess I point that out to say, really learned a lot through that because I was the technical lead in that process, working with the investment bankers, saw what that looked like, but then I got to see what it looked like to have a 9-month negotiation that ended up with a great outcome.
Yeah. And so you sold the company and then decided to do it all over again.
Yeah, that's right. We had so much fun, we wanted to do it again.
Yeah, and why did you sell to then do it all over again? Was it because you wanted to build something from scratch, to have your own thing, or?
Yeah, there certainly was a huge part of that. But then really being the technology first, very focused on exploration. So we talk about E&P, exploration and production, but very focused on exploration. So how can we use technology to find a new area that's undervalued and then be an early mover? And we did that, and the company ended up being called Antioch Energy. That's the company with the private equity backing. Then we hired a CEO in Houston, so we serve on the board. My partner and I serve on the board for that company, and it's focused in a new area in eastern Oklahoma, and really taking everything that we refined and learned from the family business, and then eventually selling it, making that the focus now of the new company.
So this is such an interesting journey that you've been through of exactly that, right? Deciding to sell the old and build a new, still in the similar area, still approaching the problem. A lot of the people we have on are going through similar journeys, and people that tune into this, they're next generation leaders. They come from families where perhaps there has been some wealth, but they're also finding their identity in themselves. Were there any regrets in how you did it? What did you learn?
Yeah, learned tons. And timing is huge in any business, especially oil and gas, but really in any business. You can have a good decision-making process, but still a bad outcome. And you can also have the inverse. And whatever outcome you get, don't let it influence your decision-making process. In other words, even if you have a good decision-making process but get a bad outcome, it was still a good process you should repeat. And so some of that influence, when you're doing something new, when you're developing a new area, you have lots of choices to make on what technologies to use, what money to spend, what areas to develop. And so there's lots of things that you can look back on and say, if I had only done it this way, but that information was unknowable at the time. And I think that's an important thing to remind us now as investors, because we go through some of that decision-making process on where do you spend your time? Where do you spend your money? Whether my previous career as an operator or now as an investor, those I think are transferable lessons.
You've taken some range in the words of David Epstein.
That's right.
To now become an investor in very much a startup, right? Again, tell us a little bit about why Cortado? Why now?
So I love what we're doing now with Cortado Ventures, and the fact and the kind of why now was, we started just a few years ago. In fact, we turned 3 really through my journey as an entrepreneur and then as an angel investor, seeing the other side of the table, and that we can now support the next generation of entrepreneurs and founders was really just a once in a lifetime opportunity. And the fact that we're doing it here, where at the time there was very little venture capital in this market, but seeing that there's a huge appetite for it, like we perceived, and I think the market ended up telling us we were correct, we perceived that there's a huge appetite for organized capital investing in early stage technology companies, but doing it in our own unique way, not just because.
Yeah.
And so there's a lot of political will, a lot of investor interest in what we're doing, and even when we started in 2020, we started 2 months into the pandemic, but actually it ended up being even more conviction from our investors and from the business community to say, like, now is the time to diversify the economy, to invest in what's next. Oil and gas has really gotten us here from the last 100 years, what's going to define the next 100 years. For so long, people have been talking about we need to diversify our economy, we need to invest in technology. And I think it really, our story, me and my partners, Mike Marati and David Woods, we built our careers here, we built our companies here. And our story that our investors believe in is that we're going to take what we've learned on building companies in these sectors, in this part of the country, and we're going to help the next generation do it.
So Nathaniel, I mean, what you said that really caught me, the fact that you came to realization point that what got us here might not get us into the future, right? From point A to point B. And you started in a very old school business, oil and gas, energy, very, I guess, expected given where you're in, right? This is the economy that drives the GDP of your state, so on and so forth. That shift from oil and gas to be doing what you're doing right now in Cortado seems pretty different. How did you even, from being an operator, thinking about oil and gas, think about, let's start a venture capital firm. Let's invest into these startups that may or may not succeed. Like, how did this thinking process come about?
I actually have a lot of analogies to how it is similar to the oil and gas business because, well, the risk profile is somewhat similar. Instead of wells, they're startups. And, but also the kind of return profile that you're looking for can be very similar. In oil and gas, you call it wildcatting, and that's where you go out into a new area and you hope that something works. You think it will because of what you know. You invest in it, and you may get a zero outcome or you may get a great outcome. So actually, there's a lot of similarities in the kind of wildcatter mentality that you see from oil and gas. Certainly, think of kind of the more old school days, like really what's defined most of the history of the industry, and now applying that on a with technology companies, and really saying, but also seeing that there's been a shift that we've witnessed in this part of the country where because you've now had the digitizing of assets, you now have artificial intelligence being infused to everything, and not just ChatGPT, but now in legacy industry, we see AI in the oil field. So we've seen, even in my previous career, we were seeing how technology is infiltrating everything. And who knows those areas better than people who operated companies there? And so the shift was almost just more like the risk appetite, the ability to build companies, the ability to create a vision, sell a vision, build a team around it. Those are transferable skills.
Right.
And I guess a whole nother layer to it is if I can talk the language to people that I've known for my whole career in this part of the country, people that have seen us build our companies, know us, trust us, believe that we can do it. And if I can talk their language and get them committed as well, this thing will work. And that's what happened. And so we now have over 100 investors. Originally, most of them were from here, from Oklahoma, from the region. We now have investors from both coasts and from all over the country.
So Fund 1 was in the height of the pandemic. I hear you raised pretty quickly.
Yeah, our goal was
6 weeks or something of that sort.
Yeah,
the first one.
We got to our first closed target of $5 million in just a matter of weeks. Our goal was $10 million. We ended up raising $20 million. Wow. So we ended up raising twice our goal in about half the time.
And why do you think that happened so quickly?
Everything was over Zoom because it was all pandemic. I think so instead of us coming in from the coast and saying, we are venture capital experts, we're going to do this for you, trust us. Instead of that, we flipped on its head and said, we're company builders. You know us. We know these sectors. And there was just such high conviction that we were the people to do it, and that the time was now, and that our intuition was that there was a mismatch between the number of companies starting and the amount of private capital organized to invest in it. That was our perception. That was our experience. This book actually came out with data around the same time that proved it, and that showed that many of the markets in our part of the country, when you look at the amount of companies relative to the amount of dry powder, organized capital for startups, the largest mismatch is in this part of the country.
Right.
And so the data proved our intuition, and then everybody that's here knows it, felt it, and was willing to back it.
And the thesis is?
Investing in the seed stage, companies across energy, logistics, and life sciences, areas where we've built companies as operators. and the intersection of new technology and legacy industries. And by focusing in an area that's overlooked by coastal VC, we're able to avoid burst bubbles like what you've seen in some other areas that have, I think, been frankly overdeveloped and overinvested in, and frothy valuations abound.
Yeah, and tell us a little bit about the entrepreneurial ecosystem here.
You see a lot of entrepreneurs that are coming from industry, especially in the Mid-Continent. We see a lot of entrepreneurs that come from industry that saw a problem at their previous job and were pulling their hair out, asking themselves why there's a better way to do it. Why isn't it happening? Well, corporate R&D has been on the decline for many, many years, and now more corporations are looking to startups to basically buy or be a customer of these new technologies to remain competitive. And the requirement for companies to remain competitive is more than it's ever been, and it's technology driven. And the solutions are coming from technology startups. And so you see more and more people that are, especially kind of with the shakeup of COVID and people now really reevaluating how they want to spend their work life. You now see a record number of people quitting their jobs and starting their own company. And more of that is in the Mid-Continent, in the middle of the country, in these legacy industries, because of what we discussed earlier, where now you see new technologies that can actually be applied to these very intransigent, heavy industries and legacy industries.
And what are some of the biggest challenges that your entrepreneurs are working on that you're excited by?
Some of the themes that we're backing are AI in heavy industry. So think of like AI in manufacturing or refineries. Working like AI in real assets, areas where it hasn't been possible before. But now with the convergence of what you're seeing with things like ChatGPT, or at least that level of AI, but now being applied in heavy industry is an area that we get excited about. But, the challenges are, it's hard to do. It's like technically difficult to do. Software is one thing because you can test it, you can get real-time feedback. It's relatively less expensive to develop. But if you want to prove that something works in a manufacturing setting, well, you have to get a manufacturer to try it out. And so there's an adoption that can be difficult. And so us having LPs who are CEOs and operators in those areas helps. So in many cases, we'll introduce a company, whether or not we invest in them, to an LP who has an expertise, has a company in this area, and get a quick pilot set up so we can get to that conviction sooner, but also so the founder can get that feedback sooner.
Oklahoma City and the Mid-Continent, where are we in terms of that adoption? Is this the capital-intensive time where you need to force adoption before it gets to an inflection point? Where are we right now?
I would say we are just now starting to see corporations in this part of the country really earnestly looking at these kinds of startup technology companies as a source for corporate innovation. It's much more common to see like corporate VC in more developed markets. You're just now starting to see it here. And I think that'll be an explosive point of growth once it becomes more commonplace. And when that happens, the scale of that is massive, right? Because most of the technologies that are here are B2B. So we're not really driven by kind of consumer behavior. We're driven more by corporate behavior.
Right.
And so that's a massive inflection point that we're really just now seeing.
So talking about corporate behavior, markets are interesting recently with the fallout of regional banks, inflation, interest rates. There's so many challenges right now. How is the corporate behavior today?
So we've seen with the banks, obviously, like multiple collapses of banks that were believed to be unfathomable before. And now you're seeing banks step up in different areas that want to get into venture capital, want to get into startups, that are seeing early stage companies are not influenced as much by interest rates. And so we're seeing more attention into private markets and to earlier stage companies that are not reliant on debt, so therefore less affected by interest rates. It's difficult to raise anywhere. It's difficult to raise capital for any startup. And that's more true now than it's been in years because of this.
I had Martina Welkoff on, who leads WXR Fund, right? And it's about bringing extended reality, working with corporates, things like that. And AI, yes, it's a hype right now, but arguably in many ways, going digital may not be the core priority today. Are you seeing resistance with corporates at all, or has it shifted in that because of markets, we need to innovate, we need to disrupt?
It depends on the industry, but it certainly depends on the size of the company, frankly. The largest companies are maybe talking more about it, but it's still really hard to turn that ship. The inertia is difficult. So it's actually more kind of mid-sized companies where we see both them talking about it and doing something about it, both early stage companies and adopting technology, going digital, changing their business. So it's kind of these mid-sized companies that aren't necessarily making headlines that we see being very fast adopters. And so when we work with our companies, we say spend a lot of time there. Of course, you got to chase the big ones. You got to chase the big companies. But really spend a lot of time on mid-sized businesses, which abound in the middle of the country.
Especially here. And I've seen a lot of that, a lot flying under the radar, making millions of revenue, that are hungry to think about what next because they're entrepreneurs themselves.
Yeah, and they're scrappy and they want to be one of the big ones, and so they see this is how they do it.
Yeah, which is exciting. I actually spoke with one of your LPs, Everett, who owns the Thunder NBA team, and long before content was a thing, he had his big exit and he actually invested into Thunder because he saw the opportunity of TV rights and media and content. And in some way, I see that actually. It's unexpected for me to see, unassuming investors who are already thinking way ahead from, old school businesses in many ways.
Yeah, you're right. Actually, it's a good example. And in Everett's case, built Dobson Communications, and is now investing in with his personal money, but also with corporate money in the future. So Dobson Fiber now, but also, as you mentioned, with the Thunder. Now a big investor with us in both of our funds. So you're seeing more of that persona, where somebody who for decades has built an amazing company in an industry that's been around for a long time, but now they're fully committed both personally and corporately in what's next.
Create Like the Greats, hosted by my friend Ross Simmons, is brought to you by the HubSpot Podcast Network, the audio destination for business professionals. Each episode hosts an in-depth analysis of some of the greatest creations and creators of all time, along with deep dive conversations of the creative process that went into building companies, brands, stories, and more. An episode I really loved was actually one of Ross's earliest episodes on Masterclass and the highly effective content marketing strategies that the company applied to attain a valuation of, just over $2 billion. From SERPs to SEO, I learned a bunch, and I think you will too. Listen to Create Like the Greats wherever you get your podcasts.
Yeah. And so what's next is you're raising Fund 2, and you chose a very interesting structure, which is why we can talk about it today, a 506 C.
That's right, yeah.
So tell me about this decision, how's it going?
Yeah, so with the 506C, it's an election you can make in your SEC paperwork that basically allows you to talk about your raise, talking about what we're doing, building in public, as they say. It's very important where we are because we're building a venture capital firm in a part of the country that is not as familiar with that as an asset class. So we thought it was really important to be able to kind of tell this story as we do it, instead of having to do it kind of in secret. We now are at 100 million AUM total, and we've done that before even turning 3, and so we're very proud of that. It's a reflection both of the market's belief that what we're doing is a good idea, but also it's a reflection of our growing asset value from success of our underlying companies. We want more like us. We want other firms in the region to start and to grow. Because we need that for a vibrant ecosystem. We need lots of capital that has different focus.
Yeah.
And so that way we attract more founders, more company builders, and it becomes a virtuous cycle.
Yeah. So I was on the GP panel with a couple of your partners, and interestingly, one is called Flyover Capital, with the thesis that these flyover states should be looked at in the way that you're talking about. How have you found the investor community? What are the numbers? Do you have a sense of the MidContinent? How much capital are we talking about?
Yeah, I would say We've done some numbers that are more local specific to Oklahoma, and I can speak to that, then I can broaden it a bit beyond that too. 3.5 years ago, before COVID basically, there was about $50 million in circulation on an annual basis in venture capital, at most.
Wow.
There's now about $500 million in circulation in venture capital.
In 3 years?
Yeah, so there's been a 10x growth.
Wow.
We're a big part of that. Atento Capital is a big part of that. Many others that are focused, in the region or beyond, and everybody has kind of a different approach. But the point is, that's the amount of capital just here. If I were to broaden that a bit to the mid-continent market, so think of North Texas, Kansas City, where Flyover Capital is. They're a younger firm as well. They just started just a few years ago. That similar story, similar trajectory. The amount of capital in this broader mid-continent market has grown by at least fivefold. If we just look at this kind of 6-state area. And again, that's just in 3 years.
Yeah.
And so you have a lot of firms that are now on Fund 2, groups like Flyover and others that have gone from kind of a starter fund size, like somewhere in the 10, 20, $30 million range, that are now in the $50 to $100 million range in Fund 2. And I think, so not only are you seeing fund sizes double and triple, but you're seeing the number of funds go from, in some areas, 0 to 5 or 6 or more.
And in the 3 years, have there been any breakout stories?
Yeah, so actually one of our companies, Recuro Health, founded by Teladoc founder Mike Gorton, that company just started a little over 2 years ago, and they just closed a Series B. They just announced it, so we can talk about it. Massive growth, revenue, but also round size. And a couple of local firms, us and OLSF Ventures out of Tulsa, were the co-lead investors in that initial round. And Arch Venture Partners, one of the big health tech investors in the country, they followed on and then doubled down in the subsequent in the Series B. So that's been a massive growth, and I expect to see that as a unicorn very soon.
And that is the business model is essentially telehealth within Oklahoma City. What's the reach of that? Let's talk a little bit about what numbers we're looking at.
The founders in Dallas, so their team is actually a distributed team all throughout the broader Midwest as well. But you're right, it's telehealth. It's really creating a digital medical home. So all the things that technology now enables you to do in terms of at-home testing, devices, telehealth, putting that under one platform. And creating better health outcomes, but also more preventative. Customers range from just individual users, but also they're actually selling a lot to corporations. We talked earlier about that. So they're selling a lot to mid-size and larger, and including Fortune 500 companies as well, because they're seeing that they have healthier, happier employees that have better outcomes and insurance rates as well. And employers love that. And so you're really seeing that model of kind of B2B to C, and but also now with how we are different, how we behave differently, and how we interact with technology differently, post COVID, how we look at work differently, and I think all those themes are really underpinning the success of Recuro. We also like the fact that it creates more access to healthcare in populations that have a difficult time accessing it, and so a lot of places in Oklahoma and other like rural parts of America, you see, and there's a shortage of medical professionals. So technologies like this is bridging that gap.
And so you're now deep in fundraising for Fund 2. What have you learned from Fund 1 that you're taking into Fund 2?
We've really sharpened our model around what works and like where we have expertise and where we're able to add value, and that's refining within energy, logistics, and life sciences. And so I think that you'll see more conviction and more focus of the fund around those themes. Yeah. But also we're benefiting from our success and helping build a vibrant ecosystem. So yesterday's MidContinent VC Summit is a great example of that. We have many partners, including The Verge OKC, which is Oklahoma City's first entrepreneurship hub. Started last year, and they're actually located with us in this building. Yeah. A lot of different amazing partners that have now flocked to this market in Oklahoma City. That's now created this flywheel effect to now attract early stage founders that now have programming to get to the next stage where they become prime time for our investment. And then they get great support as they grow their company. And so I think we're getting better at that, but also just benefiting from now those things are here.
And so we've talked a lot about the good stuff. What were your mistakes in this journey?
So we really try to stay disciplined on the kind of deal terms that we do. For example, it's no secret. I mean, if it's a safe or a convertible note, we have to have a cap. And when we haven't done that, or when there's been a very high cap that basically is no cap, that hasn't worked out well. And so I think that if I were to broaden the lesson, I would say if you have conviction around what terms make sense for you, what deal terms make sense for you, then stick with that. It's really important to be able to do that, because if you start going outside, then it becomes too much to handle, or you end up really dooming the next round, because then it's hard to raise on a high cap, or it's hard to raise when it's uncapped for the next round. And in our business, and it's true for as investors, it's true as founders, you really have to be thinking about the next round. I mean, it sounds silly to be raising money now, but to really like structure the now round for the future round, but you have to think that way. And the times where founders haven't, it's not worked out well. And other examples would be, if you're at a very early stage as a founder working with, let's just say, unsophisticated angels, and it's okay to be unsophisticated angel. I was one at one point, who aren't using commercial terms, then that can also doom the subsequent round. Or it at least makes so much work for the next institutional investor to have to clean up that they may walk away. And so we spend a lot of time with ecosystem building and working with the community to try just to share education and to have people learn from each other, so that way you can avoid some of those mistakes.
I heard you evaluate something like 800 deals. Is that right? A year?
Yeah, so we're at that clip now. Our goal, we were hoping to look at maybe 500 a year, but we've really created this flywheel. It's now at 800 a year. Yeah.
When you say no, and obviously you say no a lot, what are the key reasons you say no?
Yeah, in some cases, it's just a really quick, it's like just not a fit. It's the wrong stage, it's the wrong sector, it's outside of our geographic focus. And we try to make that very clear. It's on the website, and we publish about it a lot. In other cases, where you get into diligence, we really will see a mismatch on product market fit. Like, it may be a great team, it may be a good idea that's either like ahead of its time, or it's in an area that's too crowded, or there's just lack of clarity on the strategy on how they're going to get adoption. Because we invest a lot at that nexus of good idea, good team, cool technology, big market, but what's the right kind of customer, what's the right kind of strategy? And we see a lot of a gap there. Like, that's the hardest part, and that's the part that we invest in. And we try to work with founders.
Does portfolio construction come into it at all? How are you thinking about your portfolio construction?
That's a big part of it too. So seed stage is definitely our priority. We do some kind of early Series A. Sometimes the nomenclature is meaningless, but we do some what others would call like kind of early or smaller Series A. We do some pre-seed, but only if there is a pilot, either that we enable or that's ongoing, a referenceable customer. So those are important pieces of kind of our investing window. And on the allocation and portfolio construction, we try to have a good blend of that. So where it's more than half seed, but then kind of have the shoulders of some exposure to pre-seed. Get in a lot of pre-seed and true seed, because that's option value. And so we can really find a company at the earliest point before they're known broadly, and be meaningful to help get them customer access, and then triple down at a later stage. So that's how we look at construction in terms of stage. In terms of sector, we like to see close to a third across energy, logistics, and life sciences.
Right.
And we also, more and more, we see energy and logistics merging, where you see like an efficiency
that makes sense.
That's applied to logistics or supply chain that saves costs on energy. So it's like, we don't know what bucket to put that in. Sometimes we just call it Industry 4.0. But that's kind of how we see allocation across those thematic areas.
And you said you triple down sometimes.
Yeah, we have more than half the fund in reserves. And I've seen I've read lots and seen lots of opinions on reserves. I saw a study that looked at reserves, and their conclusion kind of made me laugh a little bit. It said that follow-on is not worth it. You shouldn't do it. The only reason you should ever consider it is if that company had a really much better chance of working out than other investments. And I'm like, that's what the reserve is for, is the company that's doing well, that's hitting targets, and that you want to triple down on. Maybe some people think of reserve as like automatic follow-on. It's like, no. We don't follow on to every company, even companies that have successful up rounds. It really has to be the best use of those next incremental dollars, and high conviction around where the company is and the growth. And we try to be very clear about that. And sometimes we hit it, sometimes we don't.
So I asked you this question about founders, you saying no to founders. When LPs you've pitched have said no to you, what is the primary reason?
It would just be how long we've been around or how long we haven't been around. So we're just turning 3. Track record, yeah. And some people love emerging managers as a concept because there's a lot of information out there that shows that emerging managers, just as a general class of like fund 1 through 3, outperform. Most of the funds that have that are top decile for their vintage are emerging managers of fund 1 through 3. That's because that fund is focusing on a new thing, and venture capital is all about new things, right? And so finding, like our story, it's like, hey, we see this trend happening in this part of the country. We can do it better than anybody else. We're going to do it. So that's the underpinning of a good emerging manager. And but obviously, if you don't have a track record, if you don't have years of exits that you can point to, then I get it. I can't change that yet. We'll talk again at Fund 4, and the minimum will be higher, but it just takes time to get there.
What has been the hardest thing for you in this chapter of your journey?
I would say knowing how and when to spend time, and especially in an emerging market where there's so much ecosystem building that can be done, knowing where to spend your time. Like, it could be really, really fruitful for us to spend time developing some aspect of the ecosystem, but maybe that's not a good use of time. There's always more that you can do. I feel like if I were doing this in a very established market, then all the things would have already been done and I would just be an investor. But instead, we really feel there's a competitive advantage to spending time there, but working yourself to the bone is certainly something that I can and have been doing, and it is not the best way to maybe approach work-life balance. And so I think that would be my biggest professional challenge.
So on a journey to become the next best investor, Nathaniel Harding, it's been a great conversation. $1 billion questions is where we're at right now. Quick questions. First thing that comes to mind. All right, you ready?
I'm ready.
Your guilty pleasure.
Cigars.
3 values you want your kids to espouse.
Honesty, empathy, satisfaction.
What's your non-negotiable in working with a founder?
No jerks.
No jerks. Love it. An opinion you have that many don't actually agree with. Unpopular opinion.
Investing in the middle of the country is a good idea.
That's a good one. Well, what's your biggest insecurity?
That I don't stack up, that I came from a non-traditional background as an investor, and that I don't have the right resume.
All right. And final question. What will your legacy be, Nathaniel Harding?
Making venture capital a real asset class in Oklahoma.
Love it. And with that, thank you for your time, your insights, and sharing about the vision and the dream of Oklahoma City and the MidContinent.
Thank you. It was a wonderful time.
Awesome. It's a wrap, and we did it.
Yay.
Is there anything you felt you didn't want? Because we can trim it and post and all that.
Yeah. You're an amazing host, by the way.
Thank you.
Absolutely. Loved it. There's some spots where I'm just like, for myself.
Yeah.
But also some spots where I'm just like, didn't love that answer.
Such as?
The actually towards the end there, like took a stand thing. But anyways, it's fine. Which actually is, I sometimes kind of get mad at myself for being vanilla people pleaser. Like I want to have just mainstream views. So like my inability.
Where does that come from?
I like being liked. I grew up like a Southern Baptist, like Oklahoma family, very kind of old school, traditional mainstream. And now that's not a mainstream family. Now and the average family in America is like anything but average, you know.
That's right.
But like kind of the historical, you know, Leave It to Beaver like view of what a family or what a person should be is what I grew up with. It's hard for me to kind of bust out of that, or you know, just have more empathy and think outside of that and think like, why is that person the way they are, which is very different than the way I was told to be. I guess being like the youngest, so like I'm kind of like the missing link of the whole family. Like
You're the glue.
I'm the glue. And so like wanting everybody to get along, all those things are just ingrained in me.
Wow.
And so it's hard for me to like have a hot take.
Yeah.
It's hard for me to take an unpopular stance. And I'm not like proud of that.
And thanks so much for tuning in this week. You can subscribe wherever you get your podcasts and follow our socials on Sarah Chen Global to get the latest on the show. It would really help me out too if you enjoyed this to rate and review our show on Apple Podcasts and share your favorite episodes with a friend. I'm Sarah Chen-Spellings and you've been listening to $1 Billion Moves.